The Reserve Bank just changed their economic policy again because they decided to not cut interest rates in January. This is a change from what they've been doing because in the last 3 meetings in September, in October, in December, they cut interest rates again and again and again. We've been hearing about aggressive interest rate cuts in 2026, and now the Federal Reserve Bank has put an end to that. In January, they said that they're not going to cut interest rates, and not just that, they said expect less interest rate cuts in 2026 because according to the Federal Reserve Bank, they're anticipating only one more interest rate cut for the rest of 2026. Now, this came as a little bit of a shock, not just to people at the Federal Reserve Bank, but also to investors because the stock market saw a shock. It was a shock to the White House, and this has big implications for the economy and your money. So let's break this all down. The Federal Reserve Bank is a central bank here in the United States, and their job is to follow what's called a dual mandate, meaning they're supposed to pay attention to two things. Number one, they're supposed to pay attention to inflation, and number two, they're supposed to pay attention to the economy, more specifically the unemployment numbers. And what the Federal Reserve Bank said is that inflation is still high. Inflation is somewhere between 2.5% and 3%, depending on what day you check it. But the unemployment market is still low. He said that the job market is strong, the economy is strong. In fact, the GDP numbers, our most recent economic numbers, came in stronger than expected. So the Federal Reserve Bank is now saying inflation is a bigger problem than our economy. And because inflation is a bigger problem, we need to address that. And the way that they are going to address that is by not cutting interest rates. Now, why does that matter? Because when the Federal Reserve Bank sees a problem in the economy, they have two tools. They can adjust interest rates, they can adjust the money printer. Generally, the way it works is when you cut interest rates, that stimulates the economy, but it also stimulates inflation. Why? Because when you cut interest rates, it makes buying a house cheaper. It makes buying a car cheaper. It gives people and investors more access to debt that we can dump this money into the stock market. So generally, lower interest rates stimulate the economy, but they can also make the inflation problem worse. Likewise, turning on the money printer can stimulate the economy because when you turn on the money printer, you can hand out stimulus checks. You can give money to businesses. You can do whatever you want with it, which can create a boost in the economy. The consequence is inflation. We have seen the consequence of that after the 2020 pandemic, and we've seen it happen time and time again in the past. Now, this came as a little bit of a shock, obviously, to the stock market because the stock market was anticipating that 2026 was going to be an aggressive year for interest rate cuts. It was also a shock to the White House because President Trump has been pushing for and demanding lower interest rates. He has said time and time again that he wants the United States to be the lowest interest rates out of any developed country in the world. He says that the United States should have a 1% interest rate level. Why? Because that is going to help stimulate the economy and boost markets, but the consequence is, of course, inflation. Now you might say, well, Jaspreet, why doesn't President Trump just fire Jerome Powell, who is the head of the Federal Reserve Bank? Why doesn't he just make these decisions? And the reason why is because although it's called the Federal Reserve Bank, it's actually not a bank because you and I can't go there to deposit money. It's not a reserve because they're not sitting on any cash and they're not federal. It says so on their website. So President Trump cannot directly tell them what to do. President Trump cannot directly fire the chairman at the Federal Reserve Bank, but he can put pressure on them. The Department of Justice has recently opened up a criminal investigation on the chairman at the Federal Reserve Bank, Jerome Powell, all in a way to put pressure on the Federal Reserve Bank to do more things that the president wants, which is lowering interest rates. Now, the Federal Reserve Bank is saying, because the economy is strong, we're not going to cut interest rates. But there could also be a little bit of political games here that maybe because you're putting so much pressure on us, we're not going to put lower interest rates on the market for you. Maybe, I don't know, speculation, but these are now the games that are being played. Now, the reason why this matters is because this move obviously impacts the economy, it impacts the stock market, it impacts the housing market, and it can impact your money. Starting with the simplest, your money. If you put money into a savings account or a money market account, you get paid interest. Now, it's not that much interest, but if you put your money into a high yield savings account, maybe you get a couple percent a year, 3% a year. If the Federal Reserve Bank is cutting interest rates, the interest rate that you get from your CD, from your savings account, from your money market account generally goes down. So because the Federal Reserve Bank did not cut interest rates, your savings account interest rate should stay the same. Then let's talk about the housing market, because the housing market is one of those things that has been wildly impacted because of interest rate decisions over the last 6 years. Over the last 6 years, from the pandemic until now, we have seen housing prices jump up by around 60%. But at the same time, mortgage rates also went up. So if you wanted to buy a house, not only do you have to borrow 60% more dollars, but you could have gotten a mortgage for 3%, 2.8% back in 2020 or 2021. Today, you're going to borrow those same dollars at 6.5%. So it's going to cost you more money to borrow those dollars, which is why we have one of the most unaffordable housing markets in the history of time. Less and less people are able to buy houses. More people are opting to rent. People are buying houses at an older age because they just can't afford it. And this is where it is important for you to understand how this decision can impact the housing market. More specifically, what this means is the federal funds rate is the wholesale rate that banks borrow money at. Because when banks are going to lend you money, they borrow this money from somewhere else, another bank. And that interest rate that banks borrow money at is called the federal funds rate. And then they sell it to you at a marked up price, the retail rate. This is your mortgage rate, your home equity line of credit rate, your credit card rate. So banks are borrowing money at one rate, they're selling it to you at a higher rate. So if the Fed is not cutting interest rates, that gives banks less breathing room to lessen their mortgage rates. But that's not the only thing. The other thing that impacts mortgage rates, which is arguably even more important, is what's called the 10-year yield. Because when banks have, let's just say $1 million to lend out, they're going to look at their investment options. They can lend their money to you. They can also lend their money to the United States government, because the United States government is always borrowing money. This is called a Treasury. And when the government is paying back their interest, they are known as a risk-free investment because they always have the ability to pay. Why? Because they can just raise your taxes, or number two, they can just get that money printed by the Federal Reserve Bank. That's why the government can always pay their bills. So if the bank has $1 million to lend out and they're deciding who to lend it to, they're going to charge you a higher rate of interest than the United States government, because you can default, you can get laid off, you might forget to make a payment, and because of the risk of lending their money to you, they need a premium for that. That's why they have to charge you a higher rate of interest than the 10-year Treasury yield. So if you want to get an idea of where the mortgage rate market is moving, pay attention to the 10-year Treasury yield. If it's going up, your mortgage rates are going to go up. If it's going down, your mortgage rates are going to go down. Now you're going to say, well, Jaspreet, what impacts a 10-year Treasury yield? The first thing is the federal funds rate. Higher federal funds rates, higher 10-year yields. The second thing is the economy. The third thing is concerns about inflation. The reason being is if I'm an investor and I think that an economy is going to go down, I think we're going to go into a recession, I don't want to own the companies that are about to suffer. I want a safer investment. So instead of putting my money in the stock market, investors will put their money into bonds like the 10-year Treasury yield. So now investors will want a safer investment like lending it to the United States government. And because now more dollars are going to the United States government, they don't need to incentivize you. So they're going to offer lower interest rates. So when people are concerned about the stock market, they put their money in bonds, Treasury yields go down because the government doesn't need as big of incentives. Likewise, when there's concerns about inflation, there's concerns about the dollar losing value, there's concerns about the dollar no longer being the world's reserve currency, well, now the government will need to incentivize you with higher interest rates to lend money to the United States government because you're going to be paid back with dollars. And right now we've been seeing a lot of concerns about the dollar. We've been seeing a lot of geopolitical concerns. We've been seeing a lot of tensions about inflation. And that has been one of the reasons that 10-year yields and Treasury yields in general have been propped up, is because of concerns about the dollar. Is the dollar losing its dominance in the world? Is the dollar losing its strength? Because 2025 was one of the worst years for the dollar in about a decade. And we've heard President Trump say publicly that he wants a weaker dollar, because if we have a weaker dollar, foreign countries will be able to buy more stuff from the United States because their currencies will be stronger. So things to be aware of when it comes to the housing market. Then let's talk about the stock market, because generally the way that it works is higher interest rates put downward pressure on the stock market. That doesn't mean that the stock market goes down. It means that it doesn't go up as much. Because when you have higher interest rates, institutions and investors borrow less dollars, which is less dollars going into the stock market. Now, the price of any asset, stocks, real estate, crypto, gold, doesn't matter, always depends on supply and demand. When you have more buyers than sellers, the price of an asset goes up. More sellers than buyers, it goes down. And the stock market doesn't care if you're buying stocks with debt or money in your bank account. So when you have lower interest rates, institutions on Wall Street can borrow a lot more dollars and dump it into the stock market, which can prop up markets. And that's one of the reasons why President Trump wants to see lower interest rates, because when you have these lower interest rates, now all of a sudden people will be willing to throw more money into the markets. Valuations go up. People can be more speculative and make more risky investments, because if you can borrow money for 3%, you only need a 4 or 5% return to make that worthwhile. But if you're borrowing money at 6, 7, or 8%, now you need to see a 10% return to make it a worthwhile investment at a minimum. So you need much higher returns, and you don't want to take on as much risk. But if you can get money for cheap, you can take a lot more risky investments. So when you have lower interest rates, speculative investments boom. When you have lower interest rates, markets can boom, valuations go up. And that sometimes is not a good thing, because when you have these extremely high valuations, that's how you build bubbles. And this is where the Federal Reserve Bank is saying, hey, you know what? Yeah, the economy looks strong, but we want to bring this inflation down, because if we have an inflation problem, that could be a bigger problem to deal with in the future. Now, the last part of this puzzle that makes it extremely confusing is that in May 2026, Jerome Powell's term is going to expire. And President Trump has made it clear that he wants to replace Jerome Powell with somebody who is going to do whatever he wants, and we know that President Trump wants lower interest rates. So as of now, the Federal Reserve Bank says that they don't want to cut interest rates. What's going to happen in May? Only time will tell. These are the things you want to pay attention to, because yes, it can impact your money, but it can also impact the economy and the stock market. So things you want to pay attention to. Obviously, I've been working to keep you updated here on my YouTube channel. But if you're an investor and you want to stay up to date on what's happening in the markets, plus you want a free masterclass on how you can get started as an investor, I'll even show you the exact framework that my firm and I use to research investment opportunities. Put together a brand new free investing masterclass for you that you can watch. When you register for the masterclass, you're going to get access to market briefs, which is my newsletter for investors, completely free. I have that link for you down in the description below. And if you got value out of this video, the best thank you is a referral. So if you could please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you.